Hey guys, it's Lauren and Ryan here, and we're excited to be recording episode 12, which is all about tax education. And it's pretty funny because we were just talking about my tax situation and we were like, how ironic. This week is all about tax. So I'm learning and I'm excited to hear a little bit more about it because I feel like this is the most misunderstood topic when it comes to money. So take it away.
Yeah, and it's important. Hey, Loz.
It is.
It's very important to understand.
Yeah.
So this is we should have done this episode early on in the piece, Loz, but it is complex, and I think it might have actually worked out well to look back here because we're going to get the people who are truly invested in the series. Because you need people to start. This is one of those things, this is when you do your foundations and your budget. This is one of the best ways to increase your return on your overall money without taking any extra risk. And people don't understand that. People always want to come and give me money and say, make this as much, or people want to invest in stocks and take all this risk to try and get 10, 15% return. But, on your dollar, fixing your tax rate can be a 20, 25, 30% return, without actually increasing any risk at all, which is phenomenal. It's where everyone should start. But if you don't have your foundations in place, it doesn't work. So this is probably one of the most misunderstood things. And we are going to go into a bit of education. We are going to a bit of tax strategies, but very basic. I want to make it very clear. This is not financial advice. This is not tax advice. This is just general education on what you need to consider. And I highly recommend you go, this is something you see a professional about. I've tagged Carter, my personal accountant, who I highly recommend after years and years of using accountants to preach the world and deliver absolutely jack shit. I highly recommend Carter. His team, not just him, his team is phenomenal in this space. And but we also need to make sure that what we cover off today is that the part of it is to do what's right. And if you feel that this, and this is why it's important that we've done this after the start of the start of the series, is because you don't want to be a person who, and this is where accountants go wrong. So when an accountant's watching this, what I try and add to value to accountants is saving tax for the sake of saving tax. Living a shittier life just to save tax isn't what you want to do either. You want to do it to help further your goals. But if paying a little bit of tax to have a bit more money in your pocket to do certain things and make you happy in line with your goals, what you want to do, then you want to do that as well. So it's understanding what's there, but it doesn't mean you just go out there and save tax for the sake of saving tax, as much as many accountants disagree with me. So big thing was, how often do you hear or think, maybe for yourself or people out there, before you started working with us, how often did you hear people, they always say, not working a second job because my second job gets taxed more, or earning more money, I get taxed more, and you used to hear that a lot. Hey, it's very common. And it's one of the biggest misconceptions out there is people, let me say this very, 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 very loud and clear to you right now, is that you don't get taxed more for your second job. You don't get taxed more. The tax man doesn't take more of all of your money because you're earning more. Tax works in a tiered system. Every single person in the economy gets taxed in the same way. Every dollar of money you earn at that rate gets taxed the same for everybody. It just increases on that portion of money as you go up. Now, to make this clear, I'm going to put this in the email. I'm going to share it now so that you understand, because, like I said, it is without a doubt the most misconception. So this is how tax works. Let's start off on the right foot. You see that, Loz?
Yep.
Okay, so this is how tax works. This is the tax tiered tabled system, right? From zero, and this is before the budget. This is as of now. I'll show you quickly what the budget changes are. But for everyone's first $18,200 is tax free. Every single person. Okay, that first amount of money you earn, $18,200, tax free. Put that aside. Okay, so this is why if you've got someone staying at home who's not working, and this is what we'll get into later. When you got a partner that's earning all the money and the other partner not earning no money, it's quite disadvantageous, because the top end $18,200 of the partner earning all the money could be taxed at 40, 45, 50%, whereas it could be earned tax free for the person not working. So this is what we talk about with tax strategies. The next $18,200 to $37,000 is taxed at 19%. Okay, for that portion of money only. Then from $90,000 to $180,000, it's taxed at 37%. And then over $180,000, you get taxed at 45% on that money. So where you think that you're getting taxed at 45% for all your money because you earn 180K, that's not correct. You're only getting taxed 45% for every dollar you earn over 180,000. So we can see in the tax liability section, Up to if you earn $90,000, you will pay $3,572 tax plus 32.5 cents for every dollar over that 37,000. Okay, so everyone's tiers are the same. Now the budget changes slightly different. I'll leave it there. I will tag this in the email so you can have a look, but that's irrelevant at the moment. The main point around this is simply stating that everyone gets taxed the same way and everyone's dollar at certain tiers get taxed the same. So when we do tax strategies, what we're trying to do, if this is our length of money and this is the small tax and the tax gets bigger, we're trying to take the money that's getting taxed the most to use for other things so we're getting taxed less on that money. Okay, that's how deductions work. This is not, you do not get your whole money taxed to that. People are watching this right now, I guarantee you go, oh, boom, holy shit. Because that is the biggest misconception in tax completely. Let me make it clear. It is always beneficial to go and earn more money. You will pay more tax, but you will earn more. Okay? There is all your money. There is no instance where working less is more beneficial. Okay? As in the income system. Now, that's not talking about happiness, etc. I'm talking about if you need to earn more money, paying more tax to earn more money, if you need to earn more money, is beneficial. There's no argument about it. Now we just need to talk about implementing tax strategies to make that more effective. All right, so one of the things we want to talk about today, so two things we really want to cover off on. The first one is how tax works, which we've gotten into, and I'll get into it even deeper now, but that's the basis behind it. Number two is that your tax return is not a tax strategy. The amount of times people ring up, and I was saying to you before, Loz, the amount of times people will ring me a week before tax time and say, hey mate, I'm going to do my tax. What are some quick things I can claim? I don't know. It's irrelevant. You are not meant to get a tax return. Okay, this is where people go to an accountant and they get a minimal tax return and they think that was a shit account, he got me a shit return. You are not meant to get a tax return, especially if you're not doing any tax strategies. If you're just going to work every year, any money you get as a return is most likely, for 95% of people, you're scamming the system. So be happy you get anything, because you're calculating your income to put away X amount for income tax based on that system, your employer pays it. Usually it's pretty accurate. Anything you go and claim extra, which is usually dodgy, and I'm all for it, but anything you go and claim extra, it's a benefit. You're not supposed to get that money. If you do not have tax strategies in place, you are not supposed to get money back from tax. So stop carrying on about it. That is not a strategy. A tax strategy is planning 12 months or more in advance of the tax year. Okay, not your return. Your return, whatever you're getting, is a bonus. You need to stop thinking that that's a strategy. Cool?
Yeah.
All right, let's get into the crux of it. Let's get into the good stuff. So, do you have any questions yet, Loz?
No, I'm just enjoying this. I'm pretty sure I was one of those people that used to say, you get taxed more on a second job. And I think I just said it because I heard other people say it. I don't think I actually knew what I was talking about.
No one does. No one. It's crazy.
Yeah.
It's crazy to me that, and people, again, we'll cover off on that thing. We should have learned this at school. Piss off. Half of you don't even learn it now. You know what I mean? Like, you got to stop blaming the schooling system. Yeah, the schooling system's flawed, but I wouldn't have listened as a kid. Someone said tax, and I said, who cares? Like, moved on. So you got to stop carrying on about we should have been taught this at school and learn it now, because most of you have been out of school for a long time and you haven't got off your ass to go learn it. So there's no way. And the information's there. This is a classic example. The amount of unsubscribers we have every week because it gets too hard is phenomenal. So don't use excuses. It's here now. Learn it. The other thing is you got to make sure that don't become this person who spends $1 to save 50 cents. That's another big mistake, is people going, but it's a tax deduction. Yeah, but you're still spending money. Like, if you're on the highest tax rate and you spend $1, you're only getting 50 cents back for that, right? So if you're buying things that you don't need, even though technically you're getting it at half price because half of it's a tax write-off, you still don't need it. You've still just spent the other half of that money. Right, so it's really important that you don't fall into this category of spending $1 to save 50 cents. Or if that's for the highest tax bracket. For the lowest tax bracket, we're only saving 30 cents. So spend $1 to save 30 cents. That you're on shit you don't need. You've just spent 70 cents. You haven't saved 30. You've spent 70. Right, so you need to make sure you don't fall into that habit as well. Okay, so tax works on a few different levels. And the way it's categorized is first and foremost across two sections, from income to assets or profit. Okay, the first and foremost is from an asset base and an income base. On the income base and on the asset base, they both work depending on what entity is being taxed. Okay, so we have different entities. Now, the main different entities we're going to talk about is have individuals. So as a person, okay, as a person with a tax file number, you are an entity. We have companies, okay, so businesses with ABN numbers. They are taxed at company rates. We have trusts, okay, trusts which will be taxed at, which we'll talk about in a second, but they're taxed as well. And then we have superannuation, or which is a trust, a different type. We have pension arrangements there as well. And then we have bonds, which we talked about in the investment stuff. But we have bonds which are taxed. Essentially, they're a different entity, but they're still taxed at individual rates. We'll get into that as well. But everything comes across in those entities, right? So we have realistically 4 main entities that we can get taxed across. So we'll cover them. So individual, trust, company, and superannuation. They're the main superannuation / pension / pension. I can't even say that word. Pension. So that's the 4 entities that you really any tax distribution will get, or any distribution will get taxed at. So we'll start with the income taxes for individuals. So we just went through those tax rates, right? I'm going to put this in there. So I just went through those tax rates. So any money that hits you as a person that you use on an individual level will be taxed at your tax rate. So that's why we look at, when we distribute money, we try and utilize, because the least amount of money someone earns, the least tax they get paid. They have to pay on that total amount of money, right? So, and this is what I talk about to families. We weigh up, if you're the breadwinner, if you're a company, you should be definitely, if you own a business, you should definitely be looking at trying to distribute that money across, household, because let's actually do the numbers now. If you have one person, so let's just use an example, Loz, of what do you think a good household income is? Maybe, let's say $120,000. Okay, so one person earns $120,000. Now, you've got to remember how hard it is, in today's day and age, the average income is $80,000, right? That's the average income for Sydney anyway. So $80,000, it's very hard for someone to get to the position. Like, you're very fortunate if you're earning $120,000 or more. It's hard. The amount of work, people think, oh, lucky them. But the amount of work you generally have to do to be earning $120,000 is a lot of risk, a lot of stress, etc. Okay. So one household on $120,000 will walk away with about $88,000 in the hand after tax. Okay. So they spend almost about $32,000 in tax, which works out to be about $1,700 a week, or $73.50 a month. Okay, so they're the numbers. So, but if you had 2 people earning $60,000, right, which is still $120,000, you had 2 people, that's $50,300 a year per person. Yeah, which is $100,600 per year. So that's over $12,000 more in that household for the same gross income.
Yeah.
Not doing anything. So when we talk to families, I talk to a lot of families, and you've really got to take tax into consideration here, because especially for people who don't have a company, or people who don't have a job they love, but one partner has to stay at home, and say, let's be realistic, it's usually the wife, it's usually the female. Female has to stay home, but they want to get back in the workforce, but the male's out. And maybe he wants to be at home a little bit more. He wants to spend more time with his family, and he's doing a job he doesn't like, but he's doing it because they need the money. Now, that one person, the amount of stress and time they've got to spend to earn $120,000 is a lot. And it's hard, and I guarantee they're not enjoying it. They get home from stressful long days, and then the partner at home doesn't want to be home all the time either, and they get the family relations are up and out. Consider how much easier it is to earn $60,000. Now, this isn't putting down on anyone who earns $60,000, but you can go and earn $60,000 in a lot of industries, in a lot of easier jobs. Okay, you can earn $60,000 in a lot less time with a lot less stress. So you've got to weigh up: is it better to have that one person out there earning $120,000, paying extra tax, or could 2 of you go? And could you both work less, maybe 3 days a week each or whatever, and earn $60,000 each for less stress, come home, spend more time with the family, and you actually end up with more money? Right? To make it a little bit different as well, essentially you'd only need to both go and earn $50,000 each to equate the same amount of money that one person on 120,000.
Yeah.
Okay.
Crazy.
Which you've got to consider, and it doesn't mean it has to be equal. You don't both have. You could, in one person, you might work it out that person can earn, might drop. The male. I don't want to stigmatize people, but generally that person going out and earning 120, maybe they drop a day, or 2 days, and they earn 80,000 a year, right? Maybe that's what they do. And then the other person just needs to pick up that 40 or that 30, which might be 2 days a week. They fill in the two. So one works 3 or 4 days, the other one works 1 or 2 days. Whatever it is, you need to consider your options there, because you can earn the same amount of money doing far less on the lower tax bracket.
And you're going to get more time together anyway, because both of you can, have a few days off more a week, rather than one person probably working long hours.
That's right. And we talked about this previously in, with ethnic families especially, or with, families that come in from overseas, and Asians do this really well. Arabs do this really well. We have a lot of those clients down here as well, and they're brilliant. And people look at them, Aussies like to look at them and think, they're coming over here and stealing our jobs, this, that, whatever they're doing. That's not the case. The reason that they get ahead is because they use that dynasty mentality, where a lot of them will, 10 of them will live in one house, and they'll help one person get that home, then they'll move on to the next, and they all sacrifice that. And so when you've got 10 people in that household earning 50K a year, right? 50K a year, we just saw across two people, let's say 60K a year, we just saw across two people, there's a $12,000 saving. That's an extra 60 grand a year in that household than if 5 of them were earning 120, or if 2 of them were earning 240, So that's the mentality. I'm not saying that you need to get 10 people in your house. I'm just saying you've got to consider that option there, because the amount of effort, this is why we work as a joint and a hub for one household to go, okay, what's my motto? What's the lowest risk and most efficient way to achieve what you want to do? And that's the first step you got to look at, because most people are just wasting that to be unhappy, and they're not taking advantage of that. So that's the individual tax rates, right? Any money that hits you gets taxed individually. So the first thing you need to look at is, in your household, are you utilizing, if you've got one person not earning any money, you're pretty much throwing away $18,200 of tax-free money down the drain, okay? Which you need to really consider how you do that. So that's step one. That's in, the different tax entities, and that's the tax and individual rates, or the tiers, okay? That's how it works. Is that clear, Loz, or do I need to dive into that a bit more?
No, I feel like that was good.
Cool. Actually, I will dive in a little bit more. So with the tiers, right, when we do tax strategies, the idea is that we're trying to take the top, whatever the last dollar you earned is getting taxed at the most highest rate. So when we do a tax strategy, or when you're claiming on your tax refund, you're trying to minimize that so you fall into lower tiers. Okay, that's what we do. So the first lot of money you claim, the last lot of money you earn is the first lot of money that you claim, if that makes any sense. Yeah. All right, so the next entity is superannuation or pension. Yeah, so we talked about this a lot. Again, not an investment vehicle, it's a tax vehicle. Superannuation in accumulation phase is taxed at 15%. Pension rate taxed at 0. Okay, both of them are the lowest outside of someone earning a tax-free income. So outside of the $18,200 mark, straight away after that, it goes up to 19%. So superannuation at 15% is the most tax-effective way to hold your money. There's nowhere else you can get that level for the amount of money you can hold in there. And then in pension phase, it's tax-free. Okay. So that's how that works on the super fund. That's the tax rate on the super fund. Company tax rate. So small companies under $50 million get taxed at 27.5%. Now this is where we need to be very cautious on what happens. Where company tax rate, profits, money you hold in the company, 27.5%. For companies over 50 million, it's 30%, right? I doubt we're probably working with anyone. I don't personally work with anyone over $50 million. So we stay on that lower. So 27.5%, which is still a pretty good tax rate. The moment you distribute it to a person, it hits their personal tax rate. Okay. So you've got to understand that. That's why when you have a business, you pay yourself, what you need to live on. And it's really, you can grow wealth through the company because it's a lower tax rate generally than what you get taxed at. So you need to take that into consideration, because at the end of the day, you still want the money for you personally. A business is there to support your household. The most important business in your life is your household, but you need to do it smart. Okay, you need to do it smart from a protection and from a tax standpoint. Then we have trust. Whoa, trust there, the big crazy thing that people, No, some people think they're the be all and end all. Some people don't know what they are. So a trust is just like an umbrella. Okay, that's all it is. Just an umbrella over your entities. Okay. So what happens is the trust can hold assets, but it can't hold money. Okay. So if you have a company or a property held in trust, the asset itself can be held in there, right? But the distribution, any money that comes out of it has to go to an entity. So it has to go to a company or it has to go to a person, which will then hit your nominal tax rates. Okay. So tax effective wise can be due to the reason trust can be tax effective is because it allows you to distribute money to more people, but the actual tax rate from a trust isn't any more beneficial than income rates. It just allows you to distribute one lump sum of money. Instead of going to one person, it can allow you to distribute to multiple people, which lowers the tax rate across the board. That's the benefit. Okay. People think that you save heaps of money having money in a trust. No, you don't, because you can't keep the money in there. It has to be distributed to people. It just allows you to distribute to more people. Does that make sense? So once you distribute out a trust into a person, a normal person's tax rates apply. Then we have a bond. A bond is like a company, essentially. Like it operates on a 30% internalized tax rate. So any money held within an investment bond is internally taxed at 30%. So if you take the money out of the bond before the 8-year mark, before the tax benefits kick in, if you take the money out of the bond, essentially what will happen is you'll pay money according to your tax rate with a 30% offset. So if you have a 32.5% tax rate, you'll have to pay 2.5% on that tax. That's it, because the 30% has already been paid. After the 8-year mark, you get a third discount on your tax. After the 9-year mark, you get a 2/3, and at 10 years, it's tax free. Okay, that's the benefit of a bond. You trade off the tax for having to hold it there for a certain period of time. So that's a lot about the income tax. The next part is capital gains tax. Okay, this is capital gains when you sell. When you sell or make a gain on an asset, you have to pay capital gains tax. Now, the important thing to understand is the rules around it. Now, within 12 months, if you have an asset and you flip it within 12 months, you'll be taxed normally. Okay, you'll be taxed to the hills on an asset according to your tax rate. So when you sell an asset, the gain you make, they calculate what the gain is from, you take away whatever the expenses of the asset were versus what you sell it for. What's left is your gain. Okay, that gain will sit against your. So if you're a 32.5% tax rate, you'll be taxed that your highest money is taxed at 32.5%. That capital gain will be taxed according to that. Okay. If you are on 47%, you'll lose half of that money to tax from the gain rate. Now, what the rules are with capital gains tax is if you hold that asset for longer than 12 months, you get a 50% tax deduction. You get a 50% discount. It's called the CGT discount rule, right? So immediately what happens is after 12 months of holding, this is why long-term assets are better. After 12 months of holding that asset, you'll get your total gain will be divided by 2, which is huge, massive. Okay, that's why you've got to really consider how long you hold assets for.
So I can ask something. So we're talking about property. What other things can you pay capital gain tax on?
Any asset that you make a gain on.
So like shares, all of that.
Shares, businesses, art, luxury cars or vintage cars that are classified as assets. Pretty much anything that you buy and sell and make a gain on, you can get done for capital gains.
So if you bought a property, let's say you held it for a year or did renos to it or whatever, and at the end of that year you wanted to sell it, and let's say your gain was 100,000, they're saying you wouldn't get taxed on 100,000 anymore, or well, you still get taxed on 100,000, but you get taxed half as much as what you would. Is that right?
Yeah. So the way it works, so let's just say for ease sake that this person's tax rate is 30%. Let's just say that, right? It wouldn't be, it'd be 32.5 or whatever, but let's just say it's 30 for ease. Mm-hmm. Let's say you bought a property for 500,000. Yeah. Inside 12 months, or in 10 months, you sell it for 600,000. You take that 100,000, that's your gain. Let's just say there's no, like the expenses don't come into it. That's your gain is 100,000. You'll pay 30,000 tax.
Yeah.
Yep. If you held it for 14 months, okay, what would then happen is you would you would sell that 100 grand would be divided by 2, which would make it a $50,000 gain, and then they'd multiply that by 30%, okay, which is your tax. So you'd pay 15 grand tax. So you pay half the tax, right?
Yeah.
One of the things people got to understand, especially people with companies, is small business CGT exemptions, which is a whole different kettle of fish I'm not going to get into too much, but it basically means when you hold an asset inside a company, after a long-term period, there's certain rules around it, but after you sell it, the capital gains that you should pay, you can contribute to super up to a certain amount, which can save people millions and millions of dollars. So companies, you need to consider, if you have a business and you haven't considered small business CGT exemptions, you need to be considering that before you purchase assets. And then the other thing is inside super, I think it's about 10%. So your capital gains gets, instead of 15% over a certain amount, it gets to 10% instead. Okay, so but even if it was 15%, it's still better than most other places. And in pension phase, when we hit pension phase, any gain is zero tax free. That's why it's amazing. Okay, and the bond, that is a capital gain. So at the end of your bond, that's why a 10-year rule on a bond is really amazing, because any gain you make from that investment is tax free. Whereas if you take it out before, you just get 30% offset to that gain. Cool.
Yeah.
All right. So investment tax. Now this is general. We're just going to generalize this one. But this is basically, we talk about non-tax deductible and deductible debts and expenses, right? And this is what we come into when we talk especially about investment tax, because when you have investment tax, it can be offset by expenses. Yeah, it can be offset by expenses. So you need to understand when you're investing what the entity you're holding it in, what the deductible expenses around that investment are for those tax purposes, to make sure that you pay as little tax as possible, because tax can be the biggest killer to a lot of investments, right? It can be the biggest killer. If you want to build let's call it you want 100 grand. You want to make 100 grand a year, right? If you want to make 100 grand a year, let's do the actual numbers to make it clear. So if you want to earn 100 grand a year, you have to earn, if you want to make 100 grand a year, you have to earn about $140,000 a year. Okay. So to get 100 grand in the pocket, in your hand, 2 grand a week cash, you have to earn $140,000 a year, right? So do the math. To create that via a share portfolio outside of a tax effective way, you're going to need, you're going to need about $3 million, right? You need about 3 mil to earn enough money to pay tax on, to earn 100K a year. If you want to do that with property, you're going to need about 4, maybe 4.5 mil of debt-free property to do so. Whereas inside your super or pension environment, you only need about 2 mil, right? So I'm not saying super is the right way or anything like that, but I'm saying this is the difference between tax effectiveness and non-tax effectiveness. It can cost you the size of somebody's normal portfolio. It can be the difference. Okay, so you really need to take into consideration your tax consequences there. A big one that's missed all the time that we're recently speaking about, Loz, is estate taxes. So a lot of people with their superannuation or their insurance properties, their insurance policies, they're putting on their beneficiaries, kids that are over 18 that are non-dependents, etc. You've got to understand that when you die, right, if your money is paid to a non-dependent, so any assets paid, like cash paid to a non-dependent, can get taxed up to 30%, right? It can get taxed very, very heavily. So you need to make sure that you have the right things in place. Dependents are tax-free, non-dependents aren't. That's really the consideration there. Any property transferred, own home property, has 2 years tax-free for them to sell it, and then after that it's taxed on a different rate. So it pretty much starts their tax bracket again. But you need to understand that your estate isn't tax-free, right? Your estate is not tax-free if it's not done correctly. So you need to understand estate taxes as well, because I've seen people lose lots, not even talking about legal fees or anything yet, but I've seen people lose a lot of money to the tax man for simply putting the wrong person down on their beneficiary notices. So you need to make sure you understand that as well, because that's heavy. Now, like I said, today's not advice. I'm not going to tell you how to do that, because that's diving into actual advice, tax advice, and I could get strung up for that. So I'm just telling you these are things you need to be aware of that you might not be, because You know, that's really important in estate tax. I see you think someone has $1 million portfolio, that's 300 grand gone. And if you have an insurance policy, to, you know, a lot of people say, I'll just get enough insurance to pay off my debt. And let's say you got $1 million debt, so you get $1 million policy, but you don't do it properly, and then there you go, you lose 300 grand to taxman. The person you left behind now is $300,000 debt. Right, you've got to really consider this stuff. It's one of the biggest mistakes you see all the time. All right, last step, overlaying taxes. So what this means is overlaying each thing. So for example, you know, considering your capital gains tax being held inside superannuation. So you've got to analyze the capital gains tax and how that's affected by the superannuation tax rate as well. Okay. Or pension rate. So, you know, capital gains might work in a certain way, but then inside pension phase, it's not taxed because it's tax free. You've got to understand that, you know, with the trust, you know, how companies distributed. We got something called franking credit. So if money gets held in a company and you get taxed at 27.5%, and the company pays that tax, and then we distribute it via. So if you distribute it as a salary, well, then you don't pay the 27.5% because it's a company tax expense, and then that person will get taxed at normal rate. But then we might do what we call a franking credit, where the company will pay the 27.5% tax, but then we'll distribute that to a person as a dividend or as a profit. And then that will come with a franking credit, which means that it's already had 27.5% of its tax paid. So then you only have to pay the difference between that 27.5% and your normal tax rate. Okay, you got to understand the overlaying. Taxes don't just work on a linear scale. There are kind of, you know, different complexities around it. You need to understand what it interacts with each other. Cool. Am mine getting blown yet or what?
I'm hanging in there. No, it's good. I'm learning.
All right. So that water tastes gross. All right. So tax deduction. So we're going to solutions. What are some of our solutions? So the main things you need to consider from a simplistic point of view. I'm not getting into the complexities here. I'm staying simple, right? Tax deductions, first and foremost. So making sure you understand what's deductible, what's not. You got to be careful as well. Some people, young people especially, get really carried away with tax deductions. Go to a good accountant, because there's a lot of accountants out there that'll just set up a pop-up shop, start a company, a tax return company on a business, fold it, start again next year just to do dodgy taxes so they get a lot of people through. You've got to be really careful. You've got to have longevity behind it, because one audit can do you in forever, right? Like I've got friends of mine who did a couple of dodgy ones, you know, when they were younger, and it lasted for a few years. They claimed on all these Centrelink benefits and all this stuff, and then the next thing you know, they've got debts that they're going to pay on for the rest of their life in fines and everything, right? So you've got to be really careful around it. So tax deductions, proper deductions are always make sure you list that. Understand that realistically, the easiest way is, was it related to income production or to your job? Okay, did you have to spend that money to do what you had to do, or is it income related? Is it income generating related? Those two things are the most classic tax deduction things. Okay. Tax offset and rebate. So these are different to deductions, right? So offset and rebates, you know, like we said, franking credits from the bond. You know, there's things around pensions, around Centrelink arrangements where you can get offsets and rebates depending on what your situation is that go in. So you need to understand and explore that. You know, especially around pregnancy times. You know, low income earners in the household. Very, very important to make sure you understand what the offsets and rebates are. Salary packaging and salary sacrifice are the two huge ones. You know, we look at, you might have companies that do salary packaging options depending on their fringe benefit tax rule, which we won't get into today because it's far too complex to talk about, and that's something you need to see someone about. So the difference between packaging and sacrificing. Packaging is more so around cars, grocery shopper cards, all those things, and sacrificing usually stands directly in relation to superannuation contributions. Okay, so this is the biggest one that I get. You know, I love super and it's great, but we do talk often about you need to make sure it's on track for what it needs to be. But this is where, unless you're on huge income, a lot of accountants will just recommend everyone maxes their concessional contributions out, because obviously, you know, there's on someone who's on 32.5% tax rate, straight away that's 17.5 cents in every dollar that goes towards their super if they contribute it compared to the taxman. It makes a lot of sense. But like I said at the start, what we like to do is go worst case scenario looked after first, and then we achieve all the other goals. So home, lifestyle. And then once that's taken care of, there's money left over, then we can revisit topping up super again. Because it does make sense from a monetary point of view, but there's no point trying to get a tax deduction if you can't live the life you want to live, right? I'd rather you pay a little bit more tax and have a bit of fun at the same time. So first step, make sure your contributions, tax effective wise, it's the easiest, most efficient way to build your worst case scenario retirement fund. You should be doing that first and foremost because it's the first place you spend your money. Then address everything else. If there's money left over after your lifestyle, your debt, your mortgage, your home, your investments are looked after, then you can revisit the superannuation, because if you've just got money left over, it's better to sit it there than pay tax on it and sit in a bank account. Okay, but it's very important to understand that. Now, a lot of people ask me about leases and that kind of stuff for cars. Very individualized. Okay, very, very individualized. They've all got their pros and cons. Depends how often you're going to flip your car. Depends, what income you're on. Depends on what type of car it is, how many Ks you do. There's no one answer fits all. That's very, very, from paying cash to getting a personal loan to getting a lease, very, very, very different. The only thing that really makes sense is for companies to just purchase a car. However you purchase a car, purchase it in your own name, usually via lease or a lending, just to make sure that it's all deductible. But outside of that, you've got to really consider it for you on an individual basis. Structures. So you've got to consider what structures you're using. If you're, like I said, if you're a company or you run a business and you don't have trusts and companies in place to distribute tax around, you're crazy. You're crazy. It does make sense to be a sole trader if you earn under, say, 80K. If you earn up to 70 or 80K a year as a sole trader, you're probably just living on all that money. There's not really much else you can do. Above that, you should really start to consider trusts in companies. If you have employees, contractors, you definitely have trusts in companies in place to start building assets above that. There's no point earning 500K a year and losing half of it to the tax man to sit in a bank account. It just makes no sense, right? So definitely consider that. It's really important to make sure that strategies don't need to be complicated. The most simplistic version, the two most simplistic versions are couples. So we covered on that before. So making sure that you're assessing your household and utilizing your household tax effectively. So, could you be sharing the income better to pay less tax? Like I said, that example before, 120,000 versus 260,000 people, that's 12 grand a year straight away. That's not taking into consideration people who are on 250K. It's crazy difference money. You need to really consider what your arrangements are there. The other one the other one that's easy is the super, obviously, right? So super and sharing income are the two most simplistic tax strategies you can do. Then we go into things like debt recycling, debt management, utilizing, I guess I always talk about property on my Instagram, about owning our own home, which we talk about often, Loz. And again, I want to preface here, and Loz, you can back me up on this. It's one of the first goals I do with all my clients is to buy your own home. But I do educate a lot on that. It's not the be all and end all. And I do paint it in a negative light because financially speaking, purchasing your own home to live in is not the best way to manage your money. It's not the best way to become a homeowner. But there are emotional factors that make sense. But I do put a lot of posts about considering, because you do need to open your mind up. Because you think about this, if you want to buy a home, right, and you want to put a roof over your head, like I said, on a $800,000 property across 30 years, etc., you need to earn. So you're going to pay about $1.3 million in interest at current interest rates, which are all-time low. So to pay off $1.3 million, right, if you work out what that is per year, so let's say that's a $40,000 mortgage a year, and you work out that someone's on an average of 32.5%, that means that they're going to have to earn, to pay that $40,000, you're going to have to earn about 70 just to pay your mortgage. So 30 grand is just going to waste, not including interest. So an $880,000 property is going to cost you 1.3 including interest, and then probably close to 1.7 if you include the tax you're going to pay. So you just paid 1.7 for an $880,000 house, right? That's the reality. Whereas when we buy investment properties or we use investments, the lending is tax deductible. So the only money that you've got to earn money and pay tax on is the money that you're paying the debt down with, right? Where the rest that goes to the interest man is all pre-tax. So when you're looking at, it's probably going to save you $500,000 or more, which means you're going to be able to pay it off quicker, which means you're not going to get as much interest. So that's what we talk about, right? Is simple tax strategies, utilizing tax to your advantage. Okay, doesn't mean that's the answer for everyone. It's just considering that tax there, because you can return your money far quicker by implementing quicker, better tax strategies than you can trying to chase a bigger return and taking more risk somewhere. Cool.
Yeah, it's crazy how looking at it long term, like realistically like that, like I think people, like you said, there's so much emotion to having your own home and like that being success, they kind of forget to look at those bigger pictures of like what it actually looks like, what they have to actually earn, what they're actually going to pay, like, and like you said, interest rates are so low, like
emotionally, that's what I was saying to you, Lord. That's what we talk about all the time. Emotionally, it makes sense, but every time I ask someone why you don't want to rent, the answer is always rent's dead money. So's the money you pay the taxman, and so's the interest. Like, so's the interest, so's the insurances, so the rates. That's all dead money too. But no one considers that. We've got this stupid idea in our head that no, every dollar you spend on a house is good money. It's not. There's a lot of shit money in buying a house.
Yeah.
So it's not, if emotions are the only thing that makes sense, but you've got to weigh that up. You know, there's no point being emotional and costing yourself $1 million if you'd be happier spending that $1 million on something else, you know?
Totally. So we've got a couple of case studies here.
So we'll cruise through these, because I pretty much covered them off anyway, but actually I covered off all of them. So the couple sharing one, that's my first case study. I won't give you an exact one, but that is, you know, the 120 versus 60,000, or the 80 and 40. Yeah, you're talking, what could you do with the extra 10, 12 grand a year, Loz? Like, that's a holiday budget. You know? That's the holiday, or that's a kids, that could be different for kids going to public and private school or something. You know what I mean? Like, it's a lot of money, and it's simply done by a very, very simple strategy. So that's the first one. It's the first case study. Second case study is the investment versus purchasing home, which we literally just talked about. You just got to be aware that if you are buying a house because you think rent money is dead money, you wake up, because that's not the reason. That's not the one for you. That's not the answer. Okay. Emotionally, there are answers, but if it's just simply because you think rent money is dead money, you'll get ahead far quicker by rent vesting than you will by buying a home. All right, unless you're really shit with money, you need to use the forced savings approach. Okay, but you can do that with investment properties as well. So you need to consider that, because the case study there, we're talking $500,000 to $1 million difference in wasted money between buying a home and rent vesting. And then the last case study, super versus profile, we covered off on that as well. Like I said, your worst case retirement, to generate $100,000 a year, you need $2 million in super or / pension. You'd need about $3 million in shares outside of super, and you need about $4.5 to $5 million in property paid off debt free because of tax. That's it. There's no other reason. If they all perform the same, which they generally do, tax wise, that is the difference. You're talking double plus almost 2.5 times between, you know, a tax effective strategy and not one. So pick your poison.
Totally. Okay, so we've got some takeaways and executions for you today. So takeaway number 1.
Right, so prepare in advance. Cut out this 2 weeks out from your tax return. What can I do to minimize my tax? I don't know. So go see a dodgy tax advisor. I got nothing for you, champion. You should be going minimum 6 months out, and every year you should be planning now for 2 years down the track what that tax strategy is, because generally a tax strategy doesn't pay off for 5 years. You know, it's a 5-year cycle on a tax strategy. So you need to, it's not about what you can do now, it's about what can you do now so that in 3 years time or 4 years time that you're not paying tax. One thing I will say on that though, is for anyone who's a bit older or anyone considering, there is a new thing with superannuation that from 2018-19 financial year, there is a catch-up rule that's been brought in where any of your concessional contribution caps that you missed out on from there up to 5 years, so from 2018, 2019 to 2023, 2024, you can top up, and that top up will be calculated in that year's tax deduction. So if you missed out on $10,000 for those 2 years that are gone plus this year, that means you could have an extra $20,000 to $30,000 in tax deduction, for example, that can come off your tax, which could mean you pay no tax or very, very minimal tax. But you need to go see someone about that. But that is one way that's come in recently that you can potentially last minute catch up on tax if you have leftover money lying around at the end of the tax year.
So they can do that for a few more years still, like
So no, it'll happen. It'll go on a 5-year rolling period. So you're pretty much 2018, 2019 is the first year you can count. But it's a 5-year rule. So once we get to 2023, 2024, that'll be the last year that 2018, 2019 can be caught up on. But then next year, then after that, it'll go 5 years from 2019, 2020. So it's a 5-year rule. We just haven't breached the 5-year period yet.
Yeah.
But it'll keep going for 5 years from there.
Awesome. Takeaway number 2.
Takeaway number 2, plan long term. Tax strategies can be the lowest risk way to increase your long-term wealth. Don't pay them off. You sit money in a bank account. Like I said, you could, if you get paid tax to sit money in a bank account without taking any extra risk, you can cut out how much money you pay the tax man and put more of that to use. It's without taking, you don't even have to invest it. There's literally no risk in it. It's the lowest risk way to increase your overall net wealth.
I love that, because I think sometimes people just think I've got to earn more money to like be better off, but sometimes it's actually things that they can do to be saving themselves without taking on extra. Takeaway number 3.
Don't spend $1 to save 50 cents. So tax deductions aren't, they're not saving you money. If you don't need that thing, you're spending 50 cents. That's all it is. You're spending 50 cents on something you don't need. Even though it's half price, you're still losing money. And for most people, it's 70 cents. But probably most and foremost on that takeaway is don't compromise happiness just to save tax. So if you've got things you want to do, and you're on track for everything, that's the key, is if you're on track for everything, don't be living on noodles just because you think saving tax is more important. Enjoy your life from there, but you got to find that balance.
I think people just say they're spending that to save tax to make themselves feel better.
How many people do you see that their tax return at the end of the year is their savior? If your tax return every year is your savior, you need to see us. Like you need to sort your shit out, because that's bad. That is so bad.
I know lots of people like that. Okay. 3 things that you want people to go away and implement now.
So first and foremost, let's start easy. I want you to read those tax tables, understand tax a bit better. You just got to understand those tables. Just read those tables. I've got the link in there. It's easy. And calculate how much tax you pay at present. Just figure it out. Just know. Knowing is the first step to success, right? Understand where you sit right now and figure out how much tax you actually pay.
Cool. Number 2.
Look at the easiest ways to smartly use that money as mentioned above, and consider the partner option for couples. So I want you to look at super contributions, look at if you've got companies, etc. Look at ways that you can try and fix that up, ways that you can minimize that. And if you're a couple, I really want you to consider that splitting income idea. Like think about, if you're not happy in your job and you're just doing it for money, how can you achieve that same amount of money? But in that table will help you do that as well, that calculator, which I'll tag as well.
Yep. And number 3.
If you need to get more complex, right? So if you're doing all that stuff and you still, there's really complex ideas out there. If you're going to start investing, using debt, using companies, using structures, if you're beyond the point of your deductions, offsets, your superannuation, your couple splitting, you've done as much as you can, and you're still paying a lot of tax, book in a senior accountant. I'll tag Carter in this email again. Booking a senior accountant or myself, I would, I do a lot of strategies, but for execution, we go to Carter anyway. But book in and say professional. Get that shit sorted, because there's a million ways out there to build wealth tax effectively. And don't just, if you are worried about spending a couple of grand on a professional, you're already probably costing yourself tens of thousands in tax that you're not sorting out anyway. So, again, pick your poison. Would you rather spend less on a professional or more on the taxman? It's up to you.
Yeah, 100%. And I think a lot of people out there have good intentions. They want to get this sorted. They want to do it, but they just don't take that step. So if you are that person, just follow through, get it done. And just a little shout out to Ryan, because a girl that I recommended to Ryan, I caught up with her yesterday. She was like, I just spoke to Ryan, and turns out where they kind of went through her situation, and they could be saving a lot more than what they have been. And I remember actually just having a conversation with her a few weeks ago. She's like, I'm just not sure if I'm at the stage of getting Ryan on board. And I was like, babe, that was me. When are you ever going to get to that point? It's always next
I'll come see you when I'm ready.
Yeah. And it is a scary thing to, pay a bit more for a good accountant or invest in a financial advisor, but think about the amount of money that you could be saving. Because if that was me, I've probably saved so much, even though I am paying you money. I was also hemorrhaging money. So,
and I'll give you a little plug to myself there on that. Like, just as a thing, like the thing that you got to weigh up, people think, let's say you're living pay to pay, right? And I say, let's say, for example, my main fee is about $5,000 a year, right? My minimum fee is about 3, my main's about 5. I don't hide it, it's on my website. You can go check out how much it costs, right? And we do like a monthly membership. Now, I don't look and go, shit, you're living pay to pay, I'm just going to charge you extra. I don't take on anyone that can't afford, that I can't add value to above what I do, right? And that person you're looking at, it's funny because she emailed me and said, look, we're trying to do this, we're trying to save for a house. And I think like she was on, I think I was looking at the 250 a month category for her. She just needs the foundations. And she said that 250 months will be better going towards the house. And I said, okay, let's catch up. Let's just chat about it. And I went through their budget and I laughed. Like, you can ask her, I didn't give her a choice. I said, look, it's on. If we don't progress here, I don't ever want to speak to you. Like, I don't want you to come and touch again because this is ludicrous. You are costing, and I won't say exact numbers, but they were costing themselves over $100,000 a year in shitty money choices. $100,000, and they wanted to save $3,000 a year. So what you got to consider is, you're not spending, for me, even if my top package is $8,000 a year, right? That's my top package for my athletes and stuff. That's what I say to the athletes. They look at that and go, holy shit. But athletes are the worst, especially ones that get paid in lump sums. And I say, stop for a second. I don't want you to pay me $8,000 a year for the rest of your life. This is just what we need to do now. But right now, you are costing yourself 100, 200, even if it's 50, even if it's 20 grand, if you're costing yourself 20 grand a year in shit investment choices, wouldn't you rather pay 8 to then save 10?
Yeah.
Because you're not spending 8, you're saving 12. Now, no one that watches this most likely would ever meet my $8,000 criteria. They would sit more between the 3 and 5. So it's not about you're putting extra expenses in professional. The value is how much what I'm outlaying. It's an investment. What return are you getting on that investment? Now that client there, she's going to invest $3,000 in my services, and each year she's going to return over $100,000 back in her pocket and towards her wealth. It sounds ludicrous. Why wouldn't you do that, right? You've really got to consider that. And just to clarify what we do, anyone who has a budget surplus, and that's not. A lot of the time, I look at your budget first. People go, "I don't have any money," but that's you. That's because you're shit with it. If you have less than $1,000 surplus, right? If you have less than $1,000, I recommend you watch this, do our education, so you do our basics, because you need to get yourself sorted. When you're between $1,000 and $2,000 a month surplus, I get you on my consulting arm. So we just do cash flow courses. You just pay me monthly, a smaller monthly fee, but you just do the basics with me. And then once you're over $2,000 a month in surplus, so the ability to save or invest $24,000 a year, that's when you become eligible for the wealth management tools. And then we pick a package based on foundations, growth, or executive, depending on what suits you, and we go from there. So don't get it twisted. I don't try and sell everyone to become a client. If I turn away more people than I get on board because they need to do the basics first. And you need to make sure that the value you're getting with anything you spend is returning more than, cost is what you pay, value is what you get.
Love it. So we did have a question, so Sarah wanted to know and understand more about tax, but hopefully, Sarah, you have learnt and understand things a little bit more. So next week, we are touching on basic strategies with liquid investments. So do you want to quickly intro them into what that will be like?
Yeah, so next week, we've talked about, investments before. We can do the next couple of weeks. We're going to dive into just a couple of things. Real basic stuff. We're not going to talk about really complex, debt recycling or all this stuff. We're just going to talk about, next week's liquid investments. So talking about shares and stuff like that. Strategy you can do to improve from a base level. You're managing yourself, what you can do, we're going to talk about stuff like dollar cost averaging and how to contribute to portfolios, how to structure it. How much money to have in the bank, in the cash component versus the investment component, how much risk to take, etc. And then the week after, we're going to talk about property on the same side as well, because the strategies you use with shares, with liquid investments, are not the same strategy you can use with property. So we'll just go off that. So if you started your portfolios, just a way to try and enhance them a little bit before the last episode we do, we'll be wrapping it all up into a plan and just sort of concluding.
Awesome. Excited. Well, thanks, guys, and we'll see you next week.
See you later.